Mr. Deputy Speaker, I beg to move that a bill entitled the Insurance Amendment Bill 2022 be now read a second time. The Insurance Amendment Bill 2022, a bill consisting of only 2 clauses, seeks to extend the reorganization period under Section 281 of the Insurance Act 2018. Now, honourable members will be aware that the new Insurance Act was the subject of deliberation by at least 2 joint select committees and took years in this Parliament to be sorted out. I recall being a member of a joint select committee under former Minister HOR, and that went on for years. And then when we came back into government in 2015, and I was given the portfolio of finance, again, we submitted the legislation to a joint select committee, and that too went on for years. But fortunately, at the end of that very extended period, we were able to pass a new Insurance Act 2018 to replace the archaic legislation that existed up to that time. The question of proclamation then followed, and after relevant consultation and so on, the law was proclaimed. And one of the features of the law was the reorganization of companies under Section 281 of the Insurance Act. So, the Insurance Act was passed in this House in February of 2018 and in the Senate in May of 2018. And as I just indicated, after first being introduced in this House in many different forms as early as 2011. So it took 7 years before that bill saw the light of day and found its way into an act. The Insurance Act 2018 is the laborious result of previous Parliament's work, as just indicated, and in fact, my notes are telling me there were 4 joint select committees over numerous parliamentary sessions. The legislation, the draft legislation, also benefited from the findings of the Colm report into colonial life, consultation with and from a wide cross-section of stakeholders such as the Central Bank, the Securities and Exchange Commission, and of course insurance companies and other related actors within the insurance industry, and coordination and discussion with numerous international entities. The Act was subsequently assented to on June the 8th of 2018 and proclaimed with effect from the 1st of January 2021 through legal notice number 369 of 2021 in full, save and except for sections 184 and 185. Again, after the Act was passed and assented to, there was a significant period to allow consultation between the central bank as the regulator of insurance companies and the players in the marketplace, the insurance companies and so on. And that is why there was this period of time between the assent to the Act and the actual proclamation of the Act. The Insurance Act was then amended by the Insurance Amendment Act of 2020, which was passed in this House on January 31st, 2020, and in the Senate on the 5th of February, 2020. The Insurance Amendment Act 2020 was subsequently assented to on February 18th, 2020, and proclaimed with full effect from January the 1st, 2021, through legal notice number 371 of 2021 in full. It is significant to note, for the purpose that we are about, that the Insurance Amendment Act 2020 amended, Mr. Deputy Speaker, So, Deputy Speaker.
You proceed, member. Go ahead.
Well,
Go ahead, honourable member. Proceed.
Crosstalk is bothering me. For present purposes, it is significant to note that the Insurance Amendment Act 2020 amended Section 281 of the Insurance Act 2018 by repealing and substituting subsections 1 and 4 and inserting a new subsection 7. The sum total of the amendments to Section 281 of the Act, and as I indicated, what we're about here is to further amend Section 281 of the Insurance Act, provided much needed clarity as to how branches of foreign insurance companies were expected to reorganize their businesses to become compliant under the provisions of the Insurance Act 2018. In particular, the specific requirement under Section 21 to become a local company. Now, that is a feature of the new insurance legislation, that foreign insurance companies must incorporate a local company through which their operations would be done. In this regard, Section 281 is an important provision that provides for transition of foreign insurers from where they are now to an acceptable corporate structure in Trinidad and Tobago. It preserves the regulatory framework under the repealed Insurance Act No. 6 of 1980 for a limited period, and the applicability of the provisions on transfer and amalgamation and the facilitation of transfers and undertakings to branches of foreign insurance companies under the Insurance Act 2018. In broad terms, following the advice of the Central Bank, the reorganization process entails the following, as I indicated just now. The incorporation of a local company by a foreign insurer. And this was felt by all of the market actors and the regulator to be extremely important, that no longer should foreign companies be allowed to do business without having a corporate identity in Trinidad and Tobago. And that has all to do with the questions of liability. It has all to do with questions of assets, questions of responsibility to our citizens, and so on. And B, the application to the Central Bank for approval of the registration of the local company as an insurer. In this regard, the Central Bank must ensure all the requirements for the registration of an insurer as laid out in sections 22, 24, and 28 of the Insurance Act 2018 are properly met prior to the issuance of the approval, which includes, among other things, a fully constituted board of directors, the members of which must meet fit and proper requirements, evidence of requisite policies and procedures, a sound business plan with projections and capital adequacy requirements, controlling and significant shareholders, and, if applicable, acquirers who must meet fit and proper requirements, restructuring of the group where entities are engaged in both financial and non-financial activities, permits for acquirers, significant shareholders, and controlling shareholders as applicable, which must meet fit and proper requirements. After being satisfied that all requirements for registration are met, the Central Bank is required to consult with the Minister of Finance prior to registration of the local company. Following this, the Central Bank will issue a certificate of registration. Further, where the local insurer will own subsidiaries or have ownership interests in entities, the approval of the Central Bank is required. Additionally, the application to the Central Bank for the approval of a scheme of transfer to facilitate the transfer of all the assets and liabilities of the branch operations into the registered local company. In this context, the Central Bank must review and assess the scheme, which includes the transfer agreement and the relevant documents, to ensure that policyholders' interests are not prejudiced, subject to the transfer, and that the assets and liabilities transferred into the new local company will not result in the new company being in a lesser or less favorable financial condition than existed in the branch prior to the transfer. Additionally, the transfer of all the assets and liabilities of the foreign insurer to the newly registered local company is to be done by way of a vesting order issued by the Minister of Finance. Further, the application must be made to the Minister of Finance to issue the vesting order to transfer the business to the new company. The newly registered local company can apply to the Minister for a vesting order pursuant to Section 263 of the Insurance Act. The Central Bank will review the draft of the vesting order prior to the company's submission to the Minister of Finance to ensure that the order is consistent with the scheme of transfer and all the assets, all the liabilities of the branch are being transferred as per the scheme of transfer. Upon the Minister of Finance making of the vesting order, the transfer of the assets and liabilities will be effective on the appointed day specified in the order. Since the Insurance Act 2018 was proclaimed with effect from January 1st, 2020, and Section 281 permits a maximum period of 18 months from the commencement of the Act for the reorganization period, it means that branches of foreign insurance companies that have not yet transitioned, that should be January 1st, 2021, it means that branches of foreign insurance companies that have not yet transitioned to a local company as of June 30th, 2022, run the risk of being in contravention of Section 21, which carries criminal sanctions amounting to a fine of $10 million and imprisonment for 10 years. To give some appreciation as to the magnitude of what may happen if the deadline of June 30th, 2022 is not extended, I can cite the following figures made available from the Central Bank as of December 2021. Approximately $1.564 billion in gross premiums from these foreign entities, representative of 17% of the total combined sector. Approximately $8.209 billion in assets, representing 22% of the total combined sector. Approximately $5.498 billion in net insurance liabilities, representative of 23% of the total combined sector. So let me just reiterate. These foreign companies are responsible for 17% of premiums, 22% of assets, and 23% of liabilities. The passage of this amendment bill is therefore critical to the stability of the insurance sector in Trinidad and Tobago. Looking now at the bill itself, Clause 1 sets out the short title and is self-explanatory. Clauses 2A and B amend Sections 281(1) and 281(2) of the Insurance Act by extending the reorganization period from June 30th, 2022 to June 30th, 2023, with a proviso that this can also be such later date as may be prescribed by the Minister under Section 281(2)(a). To ensure simplicity in identifying the deadline date set out in Sections 281(1) and 2, I'm advised by the drafts people that the current formula, which required one to compute 18 months from the proclamation dates set out in legal notices, is being replaced in favor of simply identifying the proposed deadline date. This is an improvement. That is to say, the new deadline will now be June 30th, 2023. I'm also advised that the current formula of the draft in the legislation was necessary to compensate for the uncertainty of prospective dates concerning when the Insurance Act 2018 would have been proclaimed. That concern no longer exists. The proclamation has occurred, and as a result, we are able to provide with clarity the deadline date, the new deadline date for the reorganization period. Clause 2C permits the deadline date for the reorganization to be extended by order. I wish to emphasize two important features with respect to 2C. Any consideration for extending the deadline date for reorganization beyond June the 30th, 2023 has to be activated on the recommendation of the regulator, the central bank. This is a formula that has been proposed by the central bank and mirrors the criterion under Section 279 of the Act. In other words, the Minister of Finance will not on his own whimsically seek to extend the deadline date beyond June 2023, but must do so on recommendation of the regulator. Any consideration for extending the deadline date beyond June 30, 2023 is subject to parliamentary scrutiny, as I explained in another matter, because the order must be laid in Parliament and is subject to negative resolution. The central bank has been consulted in relation to these amendments. In fact, it is the central bank that has proposed them. We in finance are in agreement, and the central bank is also in agreement with these amendments. The point I wish to make, Mr. Deputy Speaker, I wish to reiterate that foreign insurance entities currently are responsible for 17% of gross premiums in the sector, 22% of assets in the sector, and 23% of liabilities. They have not been able within the 18-month period to reorganize to the satisfaction of the central bank and the Minister of Finance, and therefore we are seeking an extension to ensure that stability continues in the sector. I beg to move.